today I'm going to talk you through investing for beginners in 2022. Maybe this is the year you have decided that you're really going to figure out this investing lark and you want a little bit of guidance to help you through that. I'm hoping this video is going to be the video you need to give you the confidence to get going. Welcome to the Looking After Your Pennies YouTube channel. My name is Charlotte Jessup and I'm a financial educator. Now what I'm not is a financial advisor, and this video is not financial advice. We're going to be talking about investing, and I need you to know that this does come with risks. When you invest, your money can go down as well as up. I'm going to share with you some strategies that can help you manage your own emotions around this and also minimize some of those risks. Now, if you do decide that this is something that you want to learn more about, then I have a whole course inside my financial education membership. It's called the Money Nook. You can find the link below. Not only will you get access to my investing confidence course, but you'll also get access to a whole load of workshops too. I add a new one every month, I do live calls, and I do group coaching too. And I would love to have you join me. Anyway, let's get on and talk about how you can get started with investing as a beginner. So what is investing? Essentially, investing is putting your money into something that you hope is going to increase in value over time. There are lots of ways you can do this, and there are lots of different strategies that people use for achieving this. You could invest in anything from property to, different currencies to stocks and shares, which are the things that most people think of when they think of investing and will be the focus of what I talk about in this video. But at its base level, it just means buying something or paying into something that you think is going to pay out more in the future. It is not about saving money, okay? It's not about stuffing the cash under your mattress, and it's not about leaving it in a savings account. This is just storing your money somewhere. It's not investing it. And actually, with inflation so high and interest rates still quite low, it is not going to build wealth. If you're looking for your money to grow and actually beat the level of inflation, then investing is pretty much the only option that you have to do that. Now, obviously, you have some choices about what you invest in, and I'm going to talk you through that in just a second. So when you invest, you are hoping to utilize something called compound interest. Now, you might have learned about this in school. I used to be a maths teacher. I did that for 10 years. And this was definitely a topic that I taught multiple times to different classes every year. So I know it's on the school curriculum, but you might not have thought about it in this way. So compound interest is the idea of interest on your interest. That's normally how I introduced it as a teacher. So that might be in the way that you've heard it as well. So when you put money into an investment, or even if you put it into a savings account and you earn interest on that, you're going to get a little bit of extra money in the pot at the end of the year. Now, next year, you're going to take all of that money plus the money you earn as interest, and you're going to earn interest on that. So over time, the money grows, and it kind of grows faster than if you just had a little top up every year, because you're making money on the money that you previously made. Now, when you look at doing this with bigger percentages, so not the 0.01% that you might be getting in your savings account, but when you look at doing this with sort of some of the average returns that we see in the stock market, so if you look at, say, a 6% return or an 8% return, actually this makes your money grow at quite an exciting rate, particularly if you look long term. So the sort of investing that I encourage you to look into is long-term investing. So we're not going to be doing things like for a day. We're not going to be doing them for a week or even months. We're going to be looking at 10, 15 years plus. So typically when I talk about investing, I'm talking about people investing with the view of looking to use this money in their retirement. So we're really thinking long term. And when we think long term, we're able to benefit from that compound interest, making money on your money. Now, I did a great TikTok about this the other day, and it was talking about investing for your kids. And it looked at a few statistics. And actually, it was, how can we make your kid a millionaire by the time they reach retirement? And essentially, the amount of money you had to put in to make your kid a millionaire was only 3%. It was £39,000 you had to put in, spread out over, the course of their lifetime. You put in £39,000 of that money. Thanks to compound interest, it turns into over £1 million by the time they reach 65. So that's the power of compound interest, is a great thing to leverage, and we're going to be using that when we look at investing in the stock market. So how do you start investing? Well, before you start investing, you need to be familiar with your current financial situation. So this means you maybe need to think about the money you have coming in, the money you have going out, and potentially any debt you have as well. I don't subscribe to the idea that you need to be like completely debt-free and, you have to have a huge emergency fund to start investing. You can start investing these days with like £1. So, if you want to give it a go, then by all means start. But I do think if you are in a position where you've got high interest debt and you don't really have a budget and you're not certain of your finances, that there is a real benefit to doing some work there. Investing is much more powerful if you can do it consistently and you can leave the money in there. We want to leave it alone so that it has time to let compound interest do its work. And you don't want to be putting money in that you then need to pull out later on to pay off the credit card bill or just, pay for food. So it's a good idea to have those foundations in place. Then once you've done that, you need to follow the following steps to actually get to the point where you can invest in something. You are going to need to find the right platform. There are lots of different investing platforms out there. You might be able to do this through your current bank, or you can go to a sort of dedicated investment platform. There are loads and loads of these. So, just do a little search and you will find them. Now, you need to think about the platform that's right for you. So they're going to offer different things. So, for example, they might have different fees. They might give you access to, individual stocks, funds, or, like things like crypto, all sorts of different investments, or they might limit what you're allowed to invest in. They might give you some guidance about what to invest in. So we call these ROBO advisors. So what these do is they say, based on your appetite for risk and based on the things you want to invest in, so like ethical or non-ethical investments, we recommend that you put your money here. So it uses a series of questions and answers to help you get there. So you might want to pick a platform that kind of guides you through the process if you're new, or you might want to go ahead and choose a platform that allows you to pick and choose what you put your money into. Like I said, make sure you look at the fees. Fees are going to corrode any potential returns that you get. So you need to make sure that you find a platform with fees that aren't too expensive. You're going to pay a bit extra for the likes of ROBO advisors that guide you through the process. But if you want to do sort of a DIY version, like pick your own stocks and funds, then these fees should be lower. So have a look and find the right balance of fees and what you feel comfortable picking and choosing at this point. So that's your platform. That's the first step. Then the second step is to find some account. So within these platforms, they will offer a series of different accounts. So they will likely offer a general investment account, or sometimes abbreviated to like GIA. This is just a normal investment account. You put money in there, you can then choose where the money goes, and any money you make on that will be subjected to tax. Okay, so this is just a basic one. Literally, like every investment platform will offer this. You do need to remember, though, that tax component. So when you are investing, your investments may be subject to tax. So the two main taxes are capital gains tax and dividend tax. There's a whole other video there, so I'm not going to burden you with that now, but that's what a general investment account will do. If you want to avoid some of that, you can go for a stocks and shares ISA. So with a stocks and shares ISA, this is part of the, family of ISAs. There are 4 different types of these, and you're allowed one of each different types. So a stocks and shares ISA is one of these. You're allowed to put £20,000 into your ISAs. So, you can spread it out over your different ISAs anyhow you like, or you can just use it all for one ISA, like your stocks and shares ISA. Now, the benefit of having a stocks and shares ISA is that any money you make on that is tax-free. So if you are putting all your money in there and you make a whole load of money on the money that you put into your ISA, you don't have to pay any tax on that, okay? And because you have a £20,000 limit on that, for most normal people, that's enough. Like, that's £20,000 per tax year. So if you've got £20,000 to invest, you're probably doing all right. So you need to pick an account. Could be a general investment account, could be a stocks and shares ISA, or you might want to choose a different product. So this could be something like a pension. Now, you might have a pension through work and you might want something extra on the side of that. There are lots of benefits to pensions, and I've talked about these in other videos, so I'm not going to go into a huge amount of detail there. So at this point, you should have picked a platform, you should have picked the account that you want, so the next step is to actually put some money into it. Now, when you're picking your platform, you might have had a little look at how much is the minimum you need to put into these accounts. So some of them, like I said before, allow you to start investing with like just £1. Others require 100 or even thousands of pounds before you can start using their platforms. So this might be another consideration at the sort of like decision around the platform stage. But you can put that minimum amount in. Now, some companies will kind of set you up to automatically invest that. So you put the money in the account and then they set it up so that it automatically goes into the stocks, the funds of your choice. For other platforms, you might need to put the money in and then you have to go and actually physically purchase, this stock, this fund, whatever it is you're investing in. So you're going to need to put some money in there, you're going to need to set that up. Most of these platforms make it super easy because, that's how they make money. There'll be a big deposit button or, like buy my investments here. Okay, you're normally going to do this on, like a bank card. You type in your details, how much you want to put in, and that money will come out of your account and it will go into your investment account. You just need to make sure that you then follow step 4, deciding where you're going to put your money, okay? So this is the point where you need to make a decision about whether it's going to go into stocks, it's going to go into funds, it's going to go into crypto, all of these different places. Like I say, the platform that you've chosen and the account that you've chosen might restrict what you're allowed to invest in. So some platforms will give you like access to a whole like range of different stocks. You'll be able to buy like Apple, Tesla, whatever it is you like. Others will just go, no, there are these funds, and there might be loads of funds. There might be blended funds. There might be, like ethical ones or, some that are just in the UK, some that are just in the US, some that are just in Japan, some that are global. Okay, so all sorts of different options. This is where you're going to take that money that's in your account and you're going to decide where you want to invest it. Just putting the money into the account doesn't mean that it's invested. It's not going to do a lot of good there. It's just cash. You need to actually invest it into something. So what can you invest in then? So I touched on this at the beginning. There are lots of things that you can invest in. You are probably most likely going to end up investing in stocks, shares, funds, and bonds. So let's have a look at what these different options mean. So shares then. So shares are just a piece of a company. Like you could own a little bit of Apple, you could own a little bit of Tesla. Now, a lot of platforms these days allow you to buy like fractional shares. So like a whole share could be a whole lot of money, like hundreds, thousands, whatever. But you could buy like half of a share or a quarter of a share or, like 0.3 of a share, okay? So you don't have to own like one whole share, you can own part of that. So when you buy shares, you're buying part of a company. And these could be companies that you've heard of. There might be companies that you've not heard of, but you've done some research and you think they might be the right thing for you. Now, the benefits to doing this is that you can do the research into the companies. You can find the companies that you think are going to do well. And people literally do this as a job, like finding the right companies and deciding where to put the money. The downside to this is that you have to do that research, okay? You have to pick these companies. And if you are just invested in individual stocks, even if you only pick like 4 or 5 of them, you're going to leave yourself quite exposed to the success of that company. So this is considered a riskier strategy. Okay, so this is going to mean that, if you put all your money into one company and that company goes bust, you got nothing. Okay, so generally people don't do a whole load of this. And if they are picking individual stocks, and stocks or shares, kind of interchangeable there, if you buy individual stocks, then you want to buy lots of them, okay? So you might invest in 50 or 100 companies. So you can spread out some of that risk. It would be a very risky move to take all of your life savings and put it into one company and hope they do well. The benefit of this is that if they do well, then it's probably going to make you a whole load of money. But it comes with a hell of a lot of risk. The other option is bonds. So this is where you're actually lending your money to a company or even a country, a government, and in exchange they kind of give you some money back. Now, these are considered to be a less risky option, okay? It is, you're more likely to get the returns, but the downside to this is that they generally make lower returns. So typically what you see people doing is trying to have a balance in their portfolio. So you might have some stocks and then you might have some bonds. So you're still making money kind of whatever happens, or at least you hope, unless the market really goes blah. But you are kind of balancing that risk. You've got the more risky stock options and then you've got the bonds that are sort of ticking over and keeping it a bit more on the safe side. Now, another great option is funds. So with funds, you are essentially buying into loads of companies. So it would be a pot that contains lots of different stocks. It might even include some bonds and things in there. So lots of companies offer these, and you can buy these through most platforms, and they will give you a selection of different options. Now, some of these are what we call actively managed. So there's a person or a team that's going, oh, I think that would be good, and that's going to do well. This one's not going to do so well, so we'll get rid of that. Now, these come at an additional cost, so you will pay a higher fee for having actively managed funds. Now, my preferred option is passively managed. So this is where they take an index. So this might be something like the FTSE 100, so the top 100 companies on the London Stock Exchange. Now, what happens with these is you just go, you know what, we're going to buy all of those 100 companies and buy a little bit of all of them. And that means that if some of them do well and some of them do not so well, it all kind of balances out in the end. That's passive because we're just going, you know what, I'll take the lot, okay? You don't need somebody to pick them because it's already like a pre-made list. Other examples are things like the S&P 500. You can get global versions of these that look at stocks from like the US, the UK, Japan, and emerging markets. So there are lots of different choices out there. You can also get ethical funds. So these are ones that are looking at companies that score well on like ESG scores, so environmental, social, and governance scores, and are doing better things for the planet. Now, obviously, there are other types of investments too. You can have things like property, and there are ways to invest in property without buying a house, okay? So you can look into those. You can also invest in things like commodities, and these are things like gold and oil and wheat, okay? These tend to do well in times of turbulence because they generally hold fairly steady. There's also things like crypto. This is highly risky, very volatile, nobody really knows how it's going to pan out, but there's a lot of great technology that's associated with the world of crypto. So there might be something that you want to look into. Just make sure you're completely clear of the risks and some of the like scammier stuff that goes on with those before you put your money into anything. So there you go. That is investing for beginners. There's a whole lot more I can tell you, but I hope that this has given you enough to make a good start. A big thank you for watching. If you have any further questions you'd like me to tackle in future videos, don't forget to leave a comment below. And while you're there, hit that like button, hit subscribe, and don't forget to check back for my next video. See you then. Bye.